Hello traders and welcome to a new video on scalping options before expiration. I got a lot of questions on can you trade options before they expire? And you absolutely can, and tons of traders do. So what I want to focus on today is how we can quickly scalp these options or take advantage in the fluctuations in their premiums. Remember the premiums are right here. Right there, to make a profit. Additionally, my Master of the Books Guide to the Order Book, Guide to Order Depth, and Guide to Order Flow is on sale right now, and if you want to go pick up a copy, you can click the link in the description below. And finally, I am in London, so I do not have access to my microphone or my webcam, so bear with me because the quality for this one might not be, like top tier. So, yeah. All right, let's get into a few things that I want to talk about with how we can scalp these options. The first is, let's go look at how much can we make from scalping these options, okay? I'm going to go to the 8,500 calls. Let's go to the 7-day. What are we looking at? Well, imagine that we had bought this premium. We bought one at 0.011, and then we sold this at 0.033. We would make 0.022 Bitcoin as a profit. If we had, bought 10 at this price, then we would have made 0.22. Let's say we had shorted the option, this premium, because remember we can go long or short on any option that we want as long as there's liquidity. We'd short it at 0.035, right? And we take profit at 0.011. Well, we would have made 0.024 had we shorted one of that 8,500 call option. So there's lots of ways that we can make money with these premiums, whether we're long, whether we're short, by just taking advantage of the fluctuation in the premium, in the price of the premium. Okay. Now, one tip that I do want to give, that I'm probably going to give many more times, is whenever you're buying an option, I'd highly recommend when you set a buy order to bid between the bid price and the market price. You don't want to buy above the market price. You can think of the market price as the fair value. We don't want to pay above fair value. When you short or when you sell an option, you probably are going to want to put a limit sell between this price, between the ask price and the market price. You probably don't want to sell below the market price. That's just a tip that you can use when trading these so that you don't pay too high of a price or sell too low at a price. What you can do with these is if you are bullish or bearish on the market. Let's say right now, I'm bullish. I believe that the market's going to continue to go up. What do I do with my options to take profit within an hour and make money off this? Well, let's go look at the calls. With the calls here, I see that I could put a bid order in at 0.0305, and that's probably going to get filled because it's pretty close to the market price. Let's imagine that I do get filled at 0.0305. I get filled right there, where that purple line is, and then price goes up to 0.035, and I sell that option because I believe that the market's going to stop moving upward. Well, I would receive a profit of 0.004 Bitcoin. Now, I'm not talking about this video in any expirations or break-evens because I'm not really concerned about actually holding this until the 21st of June. All I'm trying to do is buy this option and then take advantage of the fluctuation in its premium. So if I bought at 305 and sold at 350, that might be not a terrible play. Now, when will this option increase in value? Well, when the market price increases in value. When does the market price increase in value? The first way that you can think of an option and how it increases in value is calls will become more expensive the higher that the market goes because calls become more in the money. Puts are going to become cheaper because the puts are going to be more out of the money. Second thing you need to think of for pricing of options: volatility. When do we know to buy an option? When do we know to sell? How do we do this? How do we do that? Well, focus here on the BitMEX Volatility Index that looks at historical volatility for just Bitcoin. Typically, when the market is in a pattern of low volatility, such as here, at low values, meaning low volatility, market typically transitions to a period of high volatility. Now, when the market is very volatile, you can see it then goes quickly into a period of low volatility. This red line, this red bearish engulfing candle, is showing the market becoming very involatile. This is showing the market becoming very, very volatile. Typically what you want to do is go long on options when you believe that volatility will increase, and short options when you believe that volatility will decrease. Now, why you want to go long on options when you believe the volatility will increase is because of implied volatility and what that does to the premiums. When implied volatility, or IV, rises, what's going to happen is the price of these premiums is probably going to raise as well, not taking account price fluctuation and where price is. The reason that it does is when the market's more volatile, it's more likely that out of the money puts and calls are going to become in the money, which means that it's more attractive for me to buy out of the money puts and calls. And if it's more attractive for me to buy out of the money puts and calls because I know there's a higher likelihood of them becoming in the money, then that option itself is going to become more expensive. That's why a market that is beginning to become very volatile can be a very, very good strategy to buy. We could buy at 0.0305, and if the market just skyrockets upward, we can make a lot based on volatility increasing, which is going to increase the price of these options, and two, just calls becoming more expensive as price increases. So you get the double bonus there if the market moves in a very high volatility manner upward. Now, I want to go over one final thing and then just keep this video under 10 minutes, just a quick tidbit, quick appetizer or dessert or whatever in options. And I think I can keep this under 10 minutes. Let's go back to volatility here. Now, what we talked about so far is scalping options, is going long or short on puts and calls and just trying to make money off of the changes in the premiums and not holding them until expiration. We can also do something known as a volatility play. You can be bullish or bearish in volatility. Do you expect that volatility is going to come into the market? What do? Do you expect that the market's going to have not much volatility? What do? Let's go over to a situation like right now where we believe that the market's going to become very volatile because it's not much volatility right now. I wouldn't be shocked to see a skyrocket volatility. What do? Well, we have a few options that we can take. Pun completely intended there, or halfway intended. One is a straddle, and the second is a strangle. Do not be scared of those words. They're not as scary as they sound. What that means is basically buying out of the money puts and calls. And we try to buy out of the money puts and calls because we expect the market's going to be volatile, which is going to raise the price of the premiums of these puts and calls. How do I do that? Well, I could try to buy at 0.0305 or at 0.031 on the 8,500 call here, and I pick up a call at the 8,500 strike. I could also then buy a put at 8,000 for a price of 0.018, and then I have a put and I have a call. Awesome. And I can just hold until the market becomes very volatile. When the market does become very volatile and these options become a bit more expensive, I can then sell these options for a higher premium. What's probably going to happen is if the market skyrockets upward, then obviously the call is going to become worth more and the put is going to become worth less. The good news is you are limited to your loss of the price you pay for your premium when you go long. If I pay 0.018 for a put option at 8,000, the most I can lose on this position is 0.018 Bitcoin. If I go long at 8,500 on the 8,500 strike at a price of 0.031, the most I can lose is 0.031. So if the price just crazily goes upward, the reason why this can be so profitable is this is probably going to expire worthless because the probability the price goes below 8,000 is going to be lower when the price goes higher. But this could rise a lot more than this would fall, especially if the market's very volatile. This would be known as a market neutral strategy because what you are doing is you're not betting on the market going up or down. You're just betting that volatility increases and that the that the premiums are going to become more expensive so you can sell them for higher rates. So I could buy this out of the money call and I could buy this out of the money put, and that would be called a strangle, a long strangle. Hey, let's say I want to do a straddle. What do I do? Well, what I could do is I could go to either the 8,500 or I could go to the 8,000 or I could go to different values as well. But let's go to the 8,500. With the straddle, what I'm doing, a long straddle, is I could buy this at 0.0305 like I did before, then also buy an in-the-money put at 0.0445. What I'm betting on here is that the market goes very far away from 8,500 because I bought one put and I bought one call at 8,500, and I'm hoping for very high volatility. One, I want high volatility because I'm long on options, and you're going to want high implied volatility after you buy the options. And two, I'm betting that the market goes far away from 8,500. If both of those conditions are met, we can make a lot. If one of those conditions are met, let's say price settles at, like, one day later, price is at 9,000, hey, I could then sell my call and sell my put and make a pretty decent profit. Or I could do something like I sell the call in deep profit and my put is in deep loss, but if the price goes to 9,000 then falls from 9,000, I could then sell that put, potentially in profit. So there are lots of things you can do with volatility. Just betting on the market being very volatile, like right now, and just going long on both options. All right, guys, that's going to be it for this video. What we went over is how we can place an order on these options to actually scalp. So we place a bid typically between the current bid price and the mark price. You want to get that sweet spot right in between. And with selling, you're going to probably want to get the sweet spot right in between, here and here, that and the mark price. We also went over, hey, I'm bullish or bearish on Bitcoin. What do I do? Hey, I'm bearish right now on Bitcoin. I probably want to buy a put, so I could put in, pun not intended there. I could put in a bid, for a put option, and if it fills, and then the market continues to go down, that put option will increase in value. So if I bought that guy at 0.018, and then this put just becomes more and more expensive, I can then sell that for a higher rate, such as 0.028. I make a profit of 0.01 Bitcoin. Awesome. If I had bought, quantity of 1, of course. Then we went over volatility plays, and you can look at the BVOL24H and look to bet on high volatility. You go long on options, or you could bet on low volatility. If you for some reason believe that the market's just going to be not volatile at all within the next few days, well, what you could do is you could then potentially short the put at 8,000 and short the call at 8,500. This would be called a short strangle. You're hoping that the market stays between 8,500 and 8,000 during the lifespan of these options. And you're also looking for the market to be very just not volatile. Because if there's not a lot of volatility in the market and you sell these two options, then the value of these options is going to fall, meaning that you're short, you're basically shorted volatility, and you can take profit at a lower price. Because if you short, this guy at 0.032, and then this just continues to fall because the market's just not volatile at all, then you can make a nice profit there. No matter what happens in the market, there are ways to profit with options, and that's why I really like to use them and talk about them too. You can bet on volatility, you can bet on bullishness, bearishness. There are lots of things you can do with them. I would highly recommend not just diving into these, but actually practicing, maybe doing some mock positions, such as saying, okay, I want to take a long volatility play or a bullish volatility play. I remember 10 like I bought at 0.0305. I remember 10 like I bought at 0.045. And I'm going to wait an hour, and how do those option values fluctuate? Did both go up? Did one go up? Did one go up more than the other lost value? How much profit could I have actually made? If you have any more questions on these options or want to learn more, email me, comment below, or message me on Discord in my professional day trading community that comes with the guide that I sell. With that, happy trading.